Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer here at Worth Asset Management. Today is September 25th, 2023, and I'm going to go over your three threes for the week. First, I'm going to go over the top 10 major asset classes, their performance, and how we are positioned today. Then I'm going to take a look at the chart of the S&P 500. We had another down week, and we have one more week for the end of the month and end of the quarter, and we'll see where our support and resistance zones are. And then I'm going to take a look at the top three market movers for the week. So let's jump on in.
Okay, let's go over the top three market headlines from last week. The S&P 500 and the NASDAQ posted weekly declines of 3% and negative 3.6%, retreating for the third week in a row. The setbacks were driven by steep declines on Wednesday afternoon and on Thursday in the wake of the latest U.S. Federal Reserve meeting. All 11 S&P 500 sectors finished in the red for the week. The catalyst, though, for the weakness was another big jump in Treasury yields. The 2-year climbed 8 basis points this week to 5.09, while the 10-year climbed 12 basis points this week to 4.55, now up 30 basis points for the month. These moves were largely in response to the Fed's hawkish pause on Wednesday. So the short-term yields are slightly declining for the week, while the long-term yields are starting to rise again. That is something we've got to keep out, because that means that the bond market is pricing in some danger possibly ahead. All right, the next thing is the FOMC voted unanimously to leave the target range for the Fed funds rate to be unchanged at 5.25 to 5.5. The wrinkle in the market wasn't that the Fed is decidedly hawkish at this point. It was that the Fed is still not dovish. This meeting also showed that 12 of the 19 Fed officials favored raising interest rates at least one more time, and that can be seen here on the dot plot as the September projections now show this one more rate hike in the future, possibly at the November meeting here that's coming up in about 4 to 5 weeks. It also showed that there will be fewer rate cuts heading into 2024 and 2025, which means higher for longer. All right, let's go over volatility, because that came back big time last week. It actually surged up 25%, and it actually reversed this downtrend, and it actually hit its lowest level right here since 2019, going back almost 4 years. So volatility is climbing again. However, we're still in a nice trading range for the VIX, but we're heading into October, and October is the most volatile month historically. And so we've got to keep an eye on that and be very careful heading into the month of October. All right. The last was the Bank of England kept its benchmark interest rate unchanged after raising for the previous 15 meetings, as I suggested last week. They are following in our footsteps and taking a pause here as their inflation numbers are starting to come down, but now they're starting to creep up also like ours. All right, let's go over the top 10 major asset classes, their performance, and how we're positioned. And yes, because of last week's volatility, we're starting to see some movement, especially on the short-term side, where we have the majority of the equities now in a bearish mode, while we still have the US dollar, gold, and commodities on a bullish stance. If we zoom out on an intermediate term basis, no real changes, except we have the S&P 500 and NASDAQ teetering right on that line. If we have another downturn, those will turn bearish on an intermediate term basis, and gold is right on that line. If we do get an up market in gold, we shall see that turn from bearish to bullish. All right, let's go over the chart of the S&P 500 and take a look at that. Well, we're starting to see a trend reversal. We're starting to see lower highs and lower lows, and now we just broke out of this resistance zone, and we possibly could be heading down to fill this runaway gap I've been talking about for the past 3-4 weeks. And that would put it right in this support zone here in the 42, 42.20 range. If it does come down and close that gap and then bounces, we'll see where it goes after that. But it's now within the range of that, and I highly probabilities have now increased that we broke out of this resistance zone. All right, let's go over the top 3 market movers for this week. Tuesday, Thursday, we get additional housing data. We get the Case-Shiller National Home Price Index, and right now they're projected to have risen 0.7 in July, which would mark the 6th straight month of gains following steep declines for the latter half of 2022. However, we still are negative on a year-over-year basis. So even though it's starting to look a little better, we still have some big negative numbers from last year. Pending home sales for August will be reported on Thursday. Also on Thursday, Powell will be given a town hall speech. And just like the old E.F. Hutton days, when Powell talks, people listen. So he may try to explain, smooth out, or justify some of his comments from last week. So people will be listening to what he says on Thursday. The biggest market mover, most likely for the week, will be the Personal Consumption Expenditure Index, the PCE, which is the Fed's preferred inflation gauge. And that will be for August, and prices are projected to have risen 0.5 last month, up from 0.2 the previous month, raising the year-over-year annual number from 3.2 to 3.5. So we're starting to see that swing back up. Core prices are likely to have risen also, putting it at 3.9 year-over-year. All right, so let's put that into a chart now to give it some context. And now these are the Fed's range, 3.5 to 4.2. And so since we have been coming down over the last 5-6 months, that means their projections are that inflation is going to go up over the next 3 to 4 months. So again, higher for longer, at least for the next 4 months, to get us within those ranges, which means it's still way above their target, but we've got to keep an eye on that. So these numbers that are starting to roll out, so anticipate higher prices at least throughout the end of the year. That's it for this week. Thank you for joining us. Our next update is Monday, October 2nd. As always, continue to subscribe, like, and follow, and we shall see you next week. Have a great week trading.